institutional traders will buy at the level. Now, most traders will put their stop loss a tick under the last low, and they will invariably put their stop loss at exactly where the institutional orders are.
Picture this. You place a trade. Your daily bias is perfectly planned. The price starts moving in your direction, and then boom, you get stopped out. And then immediately it reverses and hits every single take profit you had in mind. I know this has happened to most of you. It happened to me all the time when I was an unprofitable trader. Here's the thing, that move wasn't random. It was intentional. You were used as exit liquidity. And today I'm going to show you exactly why, and how to stop being the one who gets hunted. If you find some value in this video, leave a like and a comment below. It would really help me grow this channel. Before we define anything, let's start with the big question. Why does the market constantly move against retail traders right before going in the expected direction? Institutions, hedge funds, banks, market makers operate with hundreds of millions of dollars. They can't just click buy because they would move price against themselves before their order is even filled. To buy, someone has to sell to you. If you want to buy $1 billion worth of an asset, you need to find $1 billion worth of sellers willing to do it at the same time. And where do you find that volume of sellers? Below the lows. That's where all the stop losses and sell stops are sitting. That's the fuel they need. So what they do is push price toward those liquidity pools, collect all the orders, and then reverse in the direction they wanted all along. They're not doing this to ruin your morning, they just happen to need your stop loss to fund their yacht. Jokes aside, the truth is it's nothing personal. They do it because it's the only way to execute orders of that size at a good average price. And that move that stopped you out, that was exactly this process happening in real time. Now that you understand why institutions need liquidity, let's talk about what it actually is and where to find it on the chart. Liquidity is resting orders, pending orders, stop losses, buy stops, sell stops, anything sitting in the market waiting to be executed at a specific price. It comes in two main formats. First, stop losses from traders already in positions. Second, breakout orders from traders waiting for price to break a level before entering. Think about it this way. If you can't spot the liquidity on the chart, you are the liquidity. You are the fuel that institutions use to move price in their direction. So where does this liquidity sit? Above highs and below lows, always. Why above a high? Because whoever sold at that level has their stop loss just above it, and breakout buyers have their buy stop just above it too. Two separate groups of orders stacked at the same level. Same logic below lows. Sell stops from breakout traders and stop losses from buyers trying to catch the reversal. Massive concentration of orders at a single price. But not all liquidity levels are equal. Some have a significantly higher probability of being targeted. These are the four types you should be marking on your charts every single day. 1. Session highs and lows. Every session, Asia, London, New York, brings new capital and new market makers into the market. Each open introduces fresh participants with massive orders to fill. That's why the highs and lows from previous sessions are extremely high confluence targets. There's a huge concentration of orders right at those levels. You see it every day. New York opens, price pushes up to grab London highs, fills the orders, then drops. Or the reverse. It's not a coincidence, it's the algorithm running its course. 2. Equal highs and equal lows. When you see two highs at almost the same level, what retail traders call a double top, that is not a sell signal. That is a liquidity trap. Why? Because now you have two sets of orders stacked at the same level. For institutions, that's an incredibly attractive target. One move, double the orders collected. Same thing for equal lows. A double bottom is not supported. It's concentrated sell-side liquidity just waiting to be swept before a real move upward. 3. Trendline liquidity, low resistance. In an uptrend, every higher low has a cluster of orders sitting below it. 4 lows close together in a trend? That's 4 pools of liquidity stacked on top of each other. Institutions can collect 4 times the orders with a single move downward. That's what we call low resistance liquidity. It's easy for price to sweep multiple levels at once. Think about trend lines. Retail enters on the retest, places their stop loss just below the trend line. Guess where price goes before the real bounce happens? 4. External versus internal liquidity. There's one more distinction that's absolutely critical: external liquidity versus internal liquidity. External liquidity sits outside the trading range, above the main swing high or below the main swing low. This is where the real manipulation happens. It's the priority target for smart money. Internal liquidity sits inside the range. Internal swing highs and lows, fair value gaps, consolidation zones. This is what gets used as fuel to reach external liquidity. If you're trading based only on internal levels without understanding this dynamic, you're not taking liquidity, you're providing it. Now we get to the most advanced concept in this video, the inducement, and this is where even semi-advanced traders get burned repeatedly. But first, I want to thank our amazing community. I'll be rewarding the most heartfelt comments, because that kind of support is what keeps me going and motivates me to keep creating free content for you. This week's winner is this comment right here. Please reach out to my email to claim your free month of Flux Charts. Now, if you haven't read about Flux Charts yet, this is the platform I use every single day for my trades. It's completely changed how I trade. Flux can run screeners on up to 15 tickers and timeframes at once, so instead of flipping through charts, it tells me exactly where my setups are happening. They have backtesting tools to build custom strategies and test them against years of market data in seconds, so you know if a strategy works before risking any money. Here's the best part: 90% of their indicators are completely free. Plus, you can use Flux Charts even with the free version of TradingView, which is huge because you can use multiple indicators simultaneously, avoiding TradingView's 2-indicator limit. They also host daily live trading classes teaching strategies, risk management, and trading mindset. Can't join live? They have a full library of recordings. Click the link in my description and use this code to discover the fantastic promotion I got for our community. Alright, let's get back to the video. Classic scenario. Price comes into a valid supply zone. You see a double top, a clear resistance. Everything looks perfect. You go short. The problem? You just sold below a pool of equal highs. There's still a buy-side liquidity above you that needs to be collected before the market can genuinely move lower. Price pushes up, stops you out, then reverses exactly as you predicted. You got the direction right, you lost the trade because you didn't account for the inducement. The inducement is that liquidity that invites you to enter too early. The market shows you what looks like an opportunity, but it's actually a trap designed to collect your stop loss. The rule is simple. Before price makes a significant move down from a supply zone, it will typically first take out all liquidity sitting above it, almost always. Same logic works in reverse. Retail sees a third touch of an ascending trend line and buys. Institutions see all those stop losses below it. First sweep, then real move. The solution is what I call smart confirmation. Instead of entering when price touches a supply or demand zone, wait for a structural shift. What does that mean? You need to see price move from higher highs and higher lows, a local uptrend, and then break down into a lower low. That shift in structure is your validation that the liquidity has been swept and the real move is beginning. That one extra step, waiting for the structural confirmation, saves you from a stop out and locks you into a high probability trade instead. You know where liquidity sits, you understand inducement, but there's still one critical piece missing: the when. There's an old saying on Wall Street: being early is just as bad as being wrong. You can have the perfect setup, right direction, right level, right confirmation, and still lose if you enter at the wrong time. Liquidity can sit untouched for hours. It requires institutional participation to activate it, and that participation arrives in specific windows every single day. London Open, 3 a.m. Eastern. New York Open, 9:30 a.m. Eastern. The London-New York overlap, 8 o'clock to 11 a.m. Eastern. These are the windows where real institutional volume enters the market. The Asian session, low volume, consolidation, price drifts with no real purpose. It's the calm before the storm, and you don't want to be trading in the calm. When London opens, the market starts actively hunting liquidity. When New York joins, you get the highest volume period of the entire trading day. So the formula is simple. Liquidity tells you where, timing tells you when. You need both. Liquidity is the fuel, timing is the ignition. Without both, the engine doesn't run. Let's put everything together into a clear, step-by-step process. This is the exact flow I run through before every trade. Step 1. Identify trend direction and structure. Are you operating in an uptrend or downtrend? Where's the most recent valid break of structure? This gives you your direction bias. Step 2. Map all high confluence liquidity. Session highs and lows, equal highs and lows, low resistance stacked levels. Mark everything. You don't know yet which one price will target first. Step 3. Identify the trading range. Which is external liquidity, the real target? Which levels are internal and will serve as fuel on the way there? Step 4. Check for inducement. If you're about to enter a short at a supply zone, is there still buy-side liquidity above you? If yes, don't enter. Wait for that to get swept first. Step 5. Wait for the session window. London Open or New York Open. Outside those windows, the liquidity is there but inactive. Waiting outside these windows is discipline, not hesitation. Step 6. Wait for the actual sweep. Watch price take out the liquidity level with conviction. Look for what I call a V-shaped reaction. A sharp, decisive move that tells you smart money just collected those orders. Step 7. Get your confirmation. Break of structure on the lower time frame. Fair value gap filled. Only then do you enter. Not on the touch of the level, on the confirmation after it. And where do you close the trade? Exact same logic. You exit when price approaches the next pool of liquidity. Why there? Because that's an area where price has a real reason to reverse. There are pending orders there. You're not exiting randomly. You're exiting at a point where the market structure gives you justification. TP1 at the nearest visible liquidity. TP2 at the next significant order pool. Every exit has a reason behind it. Never at a Fibonacci extension. Never at an arbitrary round number. Practical example. You're short after the sweep of London highs. TP1 is on the nearest equal lows. TP2 is at the trading range low where external sell-side liquidity sits. Both exits make logical sense. If you guys found some value in this video, leave a like and a comment below. It would really help me grow this channel. Thanks for watching and see you guys next time.